Hello and assalamu alaikum everyone. I am Kashif Kamran. Going concern is an important exam topic for both the AA and the AAA exams, and I will be sharing with you the key summary today of this topic, which would be relevant for you for the upcoming exams. Now, in terms of going concern, if you take a look at the typical going concern question in the AAA exam, because in the AAA exam, the depth of the question or the magnitude of the question is much sizable, much bigger than the AA exam. And generally in the AA exam, we don't find a very elaborated question on going concern. Mostly it's down to the implication for the audit report, which I will be discussing later. But yes, in the AAA paper, the question is very well structured whenever it comes on going concern. So let's take a quick analysis of the going concern question in the AAA paper. A typical question in the ongoing concern in AAA ask you to explain the methods which is to be identified from the case study given by the examiner that may cast doubt on the going concern status of the ABC company. Now, obviously, those matters are given in the case. You need to go down and investigate those matters carefully, which you believe may cast doubt on the foreseeable future of the business organization. There could be some matters which could affect your future profits, or there could be some matters which could affect your future sales, or there could be some matters which could affect your relationship with your major customer or major supplier, or there could be some matters which could adversely impact upon your liquidity as a business organization. But again, there is no rote learn list of it. It should all be well investigated from the case study. Now, when last time this topic came in, at that point in time, the marking scheme of every going concern matter was 2 marks. So we hold that true for even the future exams, that every going concern matter which you will investigate from the case study and explain them that why this matter may cast doubt on the going concern will fetch you 2 marks. The next thing, recommend procedures the auditor should perform on the cash flow forecast. Normally, we see that the examiner give you a cash flow forecast in a going concern question, because cash flow forecast is one way through which you analyze the foreseeable future of the organization in terms of liquidity. And the cash flow forecast is one way to judge your future liquidity position as an organization, and is one way to analyze the matter that may cast doubt on the going concern status of the company. So recommending the procedures the auditor should perform on cash flow is another very typical requirement we see in the question on going concern in AAA. Or examiner might ask you, recommend the evidence that you should expect to find in the review of the working paper files for cash flow forecast. So instead of asking you the procedures, the examiner might ask you the evidence in respect of the review of the file pertaining to the cash flow forecast. Now, as a AAA student, you know how to write a procedure and how to write an evidence. I'm not going down into it. That's not the purpose of this session. This is just a summary of things which can really fine-tune you for your upcoming exam. So explaining the methods or the procedures or the evidence, and then examining team come down with explain the impact on the report of the going concern matter given in the case study. Now, that's where I will be having a discussion with you, the likely implications on audit report of a going concern matter. But this is a typical question. Procedures are worth 1 mark. Evidence is worth 1 mark. When you are writing the impact on the report, every valid point you raise will give you 1 mark. So please ensure you have practiced the past papers thoroughly for going concern, and you are good into it. I think I remember one of the question which came in the December 2018 exam, which was around going concern and covered this thing, this depth of the question. Now, journal procedures on going concern. Now, this may be relevant to a AA student, where a question might ask you what procedures the auditor perform on going concern. Might not be relevant for the AAA student because examiner gives you a cash flow and you need to make procedures around cash flows. But these are journal procedures you do make on going concern. Analyzing and discussing the cash flow, profit, and other relevant forecasts with management, because that really helps you with analyzing the foreseeable future of the organization. So you need to look into the cash flow forecast, other relevant forecasts, and discuss them with management just to build up your idea about whether the company is or is not a going concern. Reviewing the terms of the loan agreement and determining whether they have been breached. Is there any breach of the loan agreement which may call the company into trouble, or the company needs to pay the loan immediately because they have breached the loan agreement, and in that case they might face some liquidity crisis. Reading the minutes of the board where some important discussions about future must have taken place, and that important discussion about future might help auditor decide the foreseeable future of this organization. Reviewing events after the year end to identify factors relevant to going concern assumptions. So critically evaluating the adjustings and the non-adjusting events just to identify that whether these events after the balance sheet date may bring any doubt on the going concern status of the business. So these are journal procedures, which is more relevant to the AA student than the AAA student. That in the context of AAA, everything is case oriented. The next thing, and the more important thing, equally for the AA and the AAA student, is the reporting implication of going concern. How many situations are there when we talk about going concern and the reporting implications, which are covered in the ISA 570? The situation number 1 on your screen is the auditor may conclude that the management use of going concern basis is inappropriate. So the auditor is concluding that the management use of going concern basis, the basis of preparing the financial statement, is inappropriate. This means that the financial statements are effectively rendered meaningless. And ISA 570 requires auditor to express an adverse opinion on the financial statement, because financial statements as a whole are effectively rendered meaningless because the management use of the going concern basis is inappropriate in the view of the auditor. So management is saying that my company is a going concern and the auditor is saying no. So that is this situation. This is an extreme situation where auditor is not satisfied with the management use of the going concern basis in preparing the financial statement. We never see such situations. I've never seen it in the AAA or the AA exam. So this is a situation given in ISA 570, but from an exam perspective, so far, I have never seen this situation. It's been over 14 years since I'm teaching this audit papers, both AA and AAA. So again, for the future exams, you may keep this in your list. The situation number 2, which do come in exams, at least in the AAA, I have seen it, where the financial statement have not been prepared under the going concern basis of accounting. So the financial statements this time has not been prepared under the going concern basis. In the first case, they were prepared on the going concern basis, but the auditor disagreed with that. So auditor issued an adverse opinion. But in this case, the management is doing the vice versa. The management has not prepared the financial statements on a going concern basis. Rather, they have prepared it on a liquidation basis or on a breakup basis. We know that when a company is not a going concern, technically, management prepares the financial statement on a breakup basis or on the liquidation basis. And the auditor agrees with the use. And this time, the auditor is very happy with the management saying that the financial statements have not been prepared under going concern, and the auditor agrees to it this time as an alternative basis for preparing the financial statement. The audit opinion may be unmodified because auditor and management are both on the same page. So management has prepared the financial statements. The management has prepared the financial statements on a liquidation basis or on a breakup basis, and the auditor agrees to that. So definitely there will be no impact on the audit opinion, and the audit opinion may be unmodified. In our opinion, the financial statement gives a true and fair view. But look at the second bullet. This is so long as the auditor has also concluded that there is adequate disclosure in the financial statement regarding the basis of accounting. However, the auditor may consider it necessary to include an emphasis of a meta paragraph in accordance with ISA 706. If the financial statements are prepared on a breakup basis and the auditor agrees to that, there is no impact on the opinion. That's number one. But because the financial statements are prepared on a breakup basis, which is something unusual, a disclosure of the breakup basis should be given in the notes to the account. And if the management has given a disclosure of the basis in the notes to the account, the auditor will include an emphasis of a matter paragraph because it is a very important disclosure which is to be emphasized by the auditor on the audit report. So the opinion will remain unmodified because auditor agrees with the basis used. But because the disclosure is important, and if the disclosure is given by the management, then the auditor will include an emphasis of a meta paragraph for the relevant disclosure. But yes, if the management is not giving a disclosure, then there is a disagreement between the auditor and the management. Then again, the auditor has to decide the likely impact on the opinion, whether the auditor should give a qualified or an adverse opinion. So there are two things here, number one, number two. One is the basis, and the auditor agrees to the basis. So no impact on the opinion. The second is the disclosure of the basis. If the disclosure is given, the auditor will put this in emphasis of a matter paragraph, else the auditor will be issuing a qualified or an adverse opinion for the situation number two. And this is situation number two is equally relevant for a listed as well as a non-listed company. In both cases, emphasis of a meta paragraph will come in. And the situation number one was that the management was saying that the company is a going concern and the auditor disagreed to that. So that was a very severe disagreement, which resulted in an adverse opinion. Situation number two has come in past papers for at least AAA. Now let's look at the situation number three, which is the more frequently repeated situation for the AA as well as for the AAA paper. Situation three, when financial statements are prepared on a going concern basis and the auditor agree to the basis. Now, the financial statements are prepared on the going concern basis. That means the company is a going concern and the auditor agrees to that, which is very good. However, there are material uncertainties relating to the foreseeable future. So even though the company is saleable, the company will survive the foreseeable future. The company will not close down in future. And that's what the management is saying. The financial statements are prepared on a going concern basis. And the auditor says, yes, it's perfectly correct. However, this however is important. There are material uncertainties relating to the foreseeable future. Now, how should these material uncertainties be put into the financial statement? Number one, if this material uncertainty relating to the foreseeable future, which is known as MURGC, material uncertainty relating to going concern, if these are disclosed by the management in the notes to the account, the auditor will express an unmodified opinion because auditor agrees to the disclosure and will also include a separate section in the audit report entitled Material Uncertainty Relating to the Going Concern. This section will draw attention to the note in the financial statement which discloses the uncertainty. So if the financial statements are prepared on a going concern basis, an auditor agrees to that. However, there are material uncertainties and the management has given a disclosure of that, the auditor will issue an unqualified or unmodified opinion because you agree with management on everything. However, because this disclosure is important, so you will add a section known as material uncertainty relating to going concern. And in this section, you will draw attention to the disclosure. So the material uncertainty relating to going concern disclosure will come under MURGC section. A lot of times student gets confused with emphasis of a matter paragraph. Emphasis of a matter paragraph was only discussed in a situation when financial statements were prepared on a breakup basis, and that disclosure of a breakup basis was given in the notes in the situation number 2, then only we give an emphasis. But when there is a material uncertainty relating to a going concern, then a section will be added with the title MURGC. Situation 3.2 is the vice versa of 3.1. If the disclosure is not given, MURGC disclosure is not given, is not disclosed, or is not adequately disclosed. Is not disclosed means no disclosure is given. Is not adequately disclosed means partially given. Management has not given a full disclosure, but a partial disclosure. But we know auditor wants a full disclosure of everything. Auditor does not like to have a partial disclosure. So no disclosure or partial disclosure is the 3.2 situation. So the auditor should either express a qualified opinion or an adverse opinion in accordance with the ISA 705, because the management is not giving a disclosure. I believe that if it is not disclosed, then it will lead down to an adverse opinion. If it is not adequately disclosed, means partially disclosure has been given and partially not. So if it is not adequately disclosed, then a qualified opinion will be given. But not disclosed will lead down to an adverse opinion in accordance with ISA 705. In the basis for qualified or adverse opinion, the section of the audit report, the auditor should state that the material uncertainty exists, which may cast doubt on the entity ability to continue as a going concern. So you will tell in the basis of the qualified or adverse opinion that there was a material uncertainty relating to the going concern. However, the management has not given a disclosure of that, or the management has not given an complete disclosure of that. So that is the situation 3.2. And this is the most common situation which comes in the exam paper. So you should know this situation very well on your screen currently. So please ensure you recap the situation 1, which was a very extreme situation when the management was saying that financial statements are prepared on a going concern basis and the auditor disagreed to that. It leads down to an adverse opinion immediately. In the situation number 2, the auditor agree with the management on the breakup basis of the financial statement. So there will be no impact on the audit opinion. However, the management should give a disclosure of the breakup basis in the notes to the account. And if that disclosure is given, the auditor will emphasize it in the EOMP paragraph. But if that disclosure even is not given, then again, the auditor needs to think about a qualified or an adverse opinion. The situation 3 is the financial statements are prepared on a going concern basis and the auditor agrees to that. However, there are some material uncertainties, some problems relating to the company's foreseeable future. If those problems are put properly in a disclosure, the auditor will add a section MURGC in the audit report where that disclosure will be highlighted. There will be no impact on the opinion because you agree with whatever the management was doing. If the disclosure is not given or inadequately given, then in that case, the auditor needs to choose between a qualified and an adverse opinion. And in the basis of the qualified and adverse opinion, you will tell that there were material uncertainties which are not disclosed by the management. So please ensure you have a sound reporting knowledge in terms of going concern. Situation 1, 2, 3. You know the procedures as a AA student, the journal procedures. As a AAA student, you know the complete structure of the question which comes on going concern, which we discussed at the start of the session. So I hope this key summary of going concern will be helping you a lot in your upcoming exam. This is Kashif Kamran signing off from a key summary session on going concern. Wish you all the very best of luck. Take care. Goodbye and Allah Hafiz.